and we're going to get started. Mike is going to talk to us about loans. I love these classes because you always hear little tidbits here and there that you're going to plug into a conversation. I guarantee it, as long as you're having conversations, right? When you're talking to people, it's like, oh, I just heard this, and you got this takeaway now that you can get a little bit deeper. And then also, as I always say, I like these trainings because you know who to call. Well, you don't have to know everything that Mike's going to talk to you about today. Just take down his contact info, right? So Mike, come up here, give a better introduction about yourself, and let's rip into it.
Okay, thanks everybody for having us. What we want to go over today. So as an agent, have you ever gotten a question? How much? What's the down payment that I need to have? Has anybody ever had that question? Right. So there are some basics that an agent needs to know. And what I want to do is go over that and give you some of that stuff so that you can have the right conversations. Obviously, and I work with some agents that love the loan side of it. And they're always asking me, okay, explain this to me so that I can have this conversation. They want to know as much as they can about what I do. And then I have other agents that are like, I don't care what you do. I'm just going to give them to you and you do your thing. Who else needs one? I got plenty of these. So. Those that are joining online, this is the sheet that we're looking at first. Oh, camera's up here. Yeah. There we go. Just a blank loan matrix is what I call it. I'm actually going to kind of write across the top here as we go through this. But what I wanted, there's 5 loan programs mainly that we look at and talk about here in Utah. So we're going to talk about those. We've got conventional. Okay. What's the next one on there? FHA, VA, USDA, and Utah
housing.
FHA and then Utah housing conventional.
Did I do it backwards?
No, FHA first. You got it right. I think.
Okay.
Just two different ones for Utah housing.
Oh yeah, you had 2 columns.
So down payment, that's a big thing that people talk about, right? How much down payment do I need? So this is going to be a little bit of a fun interactive because we're going to test your knowledge. Some of you, like the Martins, may already know everything on here, but the rest of us may need to really know that, right?
Thanks, though.
So I just set that up. So I set you up for failure, hopefully, right? So let's start with down payments. Tell me about down payments and what are the minimum down payments that you know about in any of these programs? Oh, you need one of these sheets back there. There's one for both of you. There you go. What down payments? Anybody can chime in online, whatever. Anybody chime in on what you think down payments are for any of the programs.
I wish we would have had this class when we were brand new agents. This is really awesome.
Okay, cool.
Yeah.
Conventional 3 or 5.
Okay, 3 or 5. What's the difference between 3 or 5?
First time home buyer.
First time home buyer is 3.
3, correct.
And then 5 is everybody else. There's another program that's also 3 with conventional. Anybody know what that is? Okay, this is Home Ready and Home Possible. You do not have to be a first-time home buyer to get 3% if you qualify for one of these programs. But the hard thing about that program is you have to make less than $5,500 a month. So if you're a conventional, you make less than $5,500 a month, and you have owned a house in the past, you can do this program and get 3% down. Also, the mortgage insurance is way cheaper if you qualify for this. So it's a pretty nice program. We always try and put people into that before we put them into the first-time homebuyer program because it is actually better. Mortgage insurance is cheaper, interest rate is better, it's a better program.
Can you say the names of those programs?
It's called Home Ready or Home Possible. Those are Fannie Mae and Freddie Mac programs, and they're, yeah, like I said, we don't get to use them often. Usually people, especially now in this market, it'll be interesting to see if they, everybody has probably heard by now that they're increasing the loan limit. Has anybody heard that? We'll talk about that in a minute, but I'm assuming they will increase that income limit for Fannie Mae or for that Home Ready and Home Possible as well. Right now we're at $5,500. We could go up to $6,000 or $6,200. So a borrower making less than that can be on one of these programs. So pretty cool. FHA, what? Go ahead.
Sorry, really quick. Is there anything that's taken out of that? Like, I know that's probably pre-tax. but is there anything else?
So here's
that
the cool thing.
Mhm.
Let's say, just to get down on that program a little more, let's say you and your husband want to buy a house. You both have incomes. You make $5,500 a month. He makes $3,500 a month. Okay, is on the from that perspective, it sounds like it's too much money.
Mhm.
All we do is we don't put him on the loan. Then we just go by your income. We got $5,500. Now we are going by not deposits, we are going by gross income. So,
Okay.
and anything counts at this point. If you've got an Etsy business on the side and you're making, $300 or $400 a month on that, we add that in. That's going to show up in your bank account. We're going to see that you've got those deposits coming in. We're going to want to know where it came from. And people can get kind of knocked out of this program because of that, because they've got a side business.
Okay.
Everybody's got a side
Hey,
hustle.
Mike, before you move on, because I know we got 3 other states at least on here. Are you licensed in any other state?
We are Idaho, we're working on California, Colorado, and right now, and we're working on adding more. What did you say we have on here?
Got Oregon, Washington, Missouri.
Oregon, we're working on, Washington, we're working on, Missouri, not Missouri, so. And by the way, these programs, that $5,600 is based on Utah and county. So this program does exist in the other states, but that limit is going to be different. It depends on how much people make on average in that state. Washington may be higher, for example, it might be $7,000 in Washington, just because people make more money there than here, right? Maybe, I don't know. Okay, FHA, what's the minimum down payment?
3.5.
3.5, okay?
See, he does know what we answer.
Yeah, he does, I knew he would.
I'm gonna stop.
There's not much to that, it's just 3.5. VA, USDA, Utah Housing, anybody know these?
0.
0.
0, USDA? 0,
0.
Utah Housing? 0. So a lot of people will call, they'll ask about first-time home buyer programs. Conventional really is the only one that has the first-time home buyer program that if you buy a house for the first time, you can get 3%. But a lot of times people come to us with no money down. They've got a few $1,000s in the bank. And we end up trying to put them into one of these other programs because even the first-time home buyer program is too big of a down payment for them. A $400,000 house, that's $12,000 and many of them don't have that. So if you've got somebody with tons of money, it's great.
So speaking of first-time home buyers for some of the newer agents, I know you know this from the test, right? But a first-time home buyer can have owned a house before. Right?
Exactly. Thanks for pointing that out. Anybody know how long that is?
3.
3 years. Perfect. If they have not owned a house in 3 years, then they're a first-time home buyer. Okay. In fact, the application asks, have you owned a house in the last 3 years? And if they say no, they're a first-time home buyer, even if they have owned a house before that. Okay, good. Let's move on to seller contributions. Has anybody ever used your commission or has anybody ever had a seller? I know it's been a while, but it's starting to come back where the seller contributes to closing costs. Does that ever happen? Has anybody seen any of those deals recently?
Yeah.
They're starting to come back, aren't they, a little bit? For like the last year and a half, it's like no seller contributions. I hadn't seen them for a long time, and suddenly we're starting to see them again. There is a maximum amount that a seller can contribute. They can't do everything. And I want to make a distinction when we talk about seller contributions. Sellers can contribute to closing costs. They can't contribute to down payment. So there's a difference there. And we'll talk about that for a second, but let me hit these real quick. So we've got seller. I'm just going to put seller over here on the left, draw a line. So conventional, and people probably don't know these limits, but I'm just going to hit them real quick. It's 2% for an investment, and it's 3% for a primary. So that's what a seller can contribute to your buyer's closing cost. Everybody else is 6% across the board for all products. But let me make this distinction between a down payment and a closing cost. When we talk closing costs, these are the fees, these are the setting up the escrow, origination charges, all of this. That's all part of the closing cost. And a seller can cover all of that for us. We could make that zero in most cases. Seller, I mean, if you take a $400,000 loan, right? 3% of $400,000 is $12,000. Closing costs don't usually exceed that. They're usually well less than that in most cases. So one of the things that you can do, and this can be clever, let's say you have a $400,000 house and you say, hey, seller, if the house appraises for $415,000, would you be okay if we just up the sales price to $415,000 and you cover $15,000 in closing costs? Up to 15, right? Now, on a conventional loan, we can take 3% or $12,000. We can cover all the closing costs, and then we can buy the interest rate down for your borrower. This is really cool. Your borrower now that normally would get a 3.125, we could buy it down to a 3 or a 2.875 using the seller's funds, essentially rolling it into the loan. Nobody's really paying for this. It's just being added onto their loan, and they get a lower interest rate. So that's where this is powerful on the seller contributions. With these other programs at 6%, you can go much higher. You could buy that rate down a lot more if you wanted to. Again, the house has to appraise to make that work. Does that make sense? Questions on that? Down payment is a little different. We have what's called a minimum statutory down payment requirement. On a $400,000 house at 3%, that means our borrower has to pay $12,000 out of their own funds. It can't come from the seller. There are some exceptions to that. They can get a gift from a family member that could cover all of that down payment. That's fine, but they can't get it from the seller. They can't get it from their real estate. I mean, you guys can't discount take your commission and contribute it unless you're family, right? If you're family to your borrower, if it's your sister, you're helping them find a house, then you can contribute towards their down payment. But in most cases, down payment has to come out of their own money, and that's the hard part that people have to come up. And we call it statutory because right on the loan, it tells us this amount has to come from your borrower. And if they don't have it, then we've got to figure something out, right? Okay, so that's it for the seller contributions. Any questions about any of that?
So with that, is it that they can't actually contribute that much to that, or that you have to have that amount of funds to cover that and then they can still, do you get what I'm saying?
No.
It's part of the
So-
qualification for the loan, so the buyer has a minimum
Yeah.
contribution they have to put in, and it has to come from them or they don't qualify for that.
But if they have that amount
Uh-huh.
and then the funds come from the seller or whatever else, as long as they have that required
No.
amount, okay.
It still has to come out of their bank account. They have to
Okay.
physically write that check or do
Okay.
that wire transfer. That's a
Okay.
good question. Again, the seller, the closing costs can come from the seller. That's fine. They can come from other people. They can come from you. You can contribute towards closing costs, towards the closing costs. But the down payment itself, yeah, it's got to come from them.
Okay,
And there's a difference. Sometimes we run it. I'm doing a loan right now. The lady's got $242,000 in her bank. This is kind of interesting. We're looking over her bank statement in the last 2 months, and she's got Venmo payment, $2,000. Total of $25,000 she has received into her bank account from Venmo. Now, logic might say, well, that's in her account. We can use that money. It's not that simple. And this is where it gets sticky. We have a sourcing or a seasoning requirement. You familiar with those, source and season?
Mhm.
Yeah, anybody else heard of that, source and season? What's the difference, or do you know what that means?
Well, the money can't just appear for the down payment.
Yeah.
You gotta prove where it came from and it was actually their
Yeah.
funds.
So the seasoning is, if it's older than 60 days, it could be drug money. We don't care where it came from. We're gonna look at the drug money, right? Mike said down payments can come from drug money. Okay.
that's recorded, Mike.
So we always ask for last 2 months of, yeah, that opens up a lot of opportunities for us.
To be seen in 60 days.
So you've heard of us asking for the last 2 months of bank statements. It's pretty common. That's what we're looking for. Any deposits that have shown up in that last 2 months has to be sourced. Anything that was already in the account prior to that 2 months, we don't care where it came from. It's seasoned, so it's been in there long enough. So right now I've got $25,000 worth of Venmo deposits from this lady. We're like, where did that money come from? She sold her house in California. She sold every belonging in that house to people, and they came over and bought her furniture and beds and all that. And they paid $2,000 here, $2,500 there, and we have all these deposits, and none of it we can't use because there's no way for us to track that back to the original person and prove that where that money came from. It just says John Doe, and there's a little house emoji on her Venmo bank statement. That's all we have. That's not enough to source that money. So now we're throwing out $25,000 worth of this $240,000. It's causing us a little bit of a headache.
And this is hard to explain to people because when they have mattress money, I
Yeah,
mean, I have this happen all the time. They can't understand why they can't put the $5,000 they have in their mattress in the bank.
Mhm.
But I've got that. So you have to have those conversations as a real estate agent with your people because they'll do dumb things.
Yeah.
They don't think first because they just don't know.
now there are some ways around it, and I'm glad you said mattress money, because I had another guy that had mattress money. He sold a house, he took that money in cash and put it under his mattress. He literally said that that's what he did. And I'm like, okay. So here's what we did. I said, do you have anybody in your family that has $20,000 sitting in their bank? And he said, yeah, my brother does. I said, okay, get a gift from your brother for $20,000. And his brother gave him the $20,000, and he handed his brother $20,000 in cash. Now, we can do that. It's got to be family. That's called gifts. And the gifts, as long as it comes from family, is okay. And as long as they had that money in their account to begin with, it's okay. Actually, FHA requires us to show that they had the money in their account. Hey, how's it going?
Good, man, you?
Good. I'm gonna give you this. You can kind of follow along. As long as FHA requires us to show that they had the money in the account, conventional does not require that. We don't care. We don't need to see a bank statement from them. So conventional is the easy one to prove. If we're going conventional, just give the money to them and they can give it back in a gift and we're good. As long as we can see the wire coming from their account. Okay? So there's lots of little tricks here to get around some of this stuff. Other questions before we move on?
Is third cousin a relative for you?
That's gonna be tough.
What is
What
the?
We're talking brother,
definition?
sister, mom, dad, grandma, grandpa, cousin is fine.
Cousin is fine.
Yeah, when we get to third, I think I think once we move past that first, that
Yeah.
cousin, we're out of it.
First cousin.
Yeah. We can make arguments for a lot of that. The guidelines in the guidelines, it doesn't go and list out all those.
You're like going on.
It just says family. Yeah, we're pulling up our genealogy tree on our phone and we're like, hey, it's 9th cousin, 10 times removed. It says it right there. I can prove it. I got the app.
I'm always asking that. Do you have any relatives that can help you out?
Just kidding.
You gotta go deep sometimes.
Yeah.
Mom,
Yeah.
dad's bro.
You know, if we can prove there's a good family relationship, or even that let's say that it is more than a cousin away. Maybe it's a second cousin, but they've got a good relationship. They've been hanging out all their life, that kind of thing. If there's a way we could show that we could make a good case.
Okay.
Again, it's not spelled out, it just says family.
Something married to her cousin.
True day.
That's right.
It definitely qualifies.
And then they're immediate family. at that point. The next question on here is, what type of loans can you use for investment properties? Any ideas on that?
Just conventional.
On this one, it's just conventional.
Yeah, just conventional. Yes on this, no on all these other ones. What about duplexes, threeplex, fourplex?
Is it up to 6plex?
It's up to 4,
Is it up to 4?
Yeah.
You're buying yourself, huh?
period. Up to 4 for a residential mortgage. You go past 4, it's a commercial loan. What if you buy an investment property and you're going to live in one of the units? Does that count as an investment property? Can you use an FHA loan to do that?
Yep.
Mhm.
What about a VA loan?
Yep.
Right? So yes, you've got some flexibility there. If you live in the unit, you can actually buy an investment property and use it. Okay? One of the interesting things is when Utah Housing, we have people that buy a house with a Utah Housing loan, and then they want to go buy another house and turn that house that they're living into an investment property. Any problems with that?
Recapture money.
Utah Housing, yeah, it's they're gonna keep, let's say they're gonna keep that loan. So the recapture money is not such an issue as it is that we're turning a file into our underwriter that says their primary house, we're turning into an investment.
So Utah Housing doesn't allow you. to
They don't allow
rent
you.
Property
You
at
have
all.
to
Yeah.
refinance it.
Now with FHA, there's some flexibility with some of the other programs, but Utah Housing is very specific. You have to refinance that into another mortgage. And if you plan to immediately refinance it and then turn around and move out, we're refinancing you into an investment property at that point. So now you get investment property rates instead of primary property rates. So if people can wait, yes, let's refinance your house. Let's wait a year. And that way we can refinance it as a primary residence. Then you can go move out and buy something else.
They allow you to do after 2 years, does Utah Housing allow you to do a second one after 2 years?
A second house.
Mm-hmm.
If you're living in a Utah Housing house and you want to buy an investment property but not move into it, that's different. You can own an investment property. You just can't have the loan as a Utah Housing on an investment property. Does that make sense? Okay, yeah, good. So that covers all those. Upfront funding fees. Has anybody heard of an upfront funding fee or know what they are? An upfront funding fee. Some of the programs require that you pay a certain amount of money upfront. And it depends on the program, but there's a percentage based here. I'm gonna put upfront here. Yeah, we're jamming in here. We got some music in the background.
I could barely hear it.
It's kind of elevator music though. So it's-
It's chill bits.
So what happens on this? And I'll just go through this real quick because I'm guessing, so conventional is 0, there's no upfront funding fee. FHA has a 1.75 upfront funding fee. And then VA has a 2.3, that's the biggest one. USDA is a 1, and Utah Housing is the same. So the interesting thing, we're gonna see a lot of mirroring between Utah Housing and FHA. Utah Housing is 2 loans. The first loan is an FHA loan. The second loan is technically a conventional loan that pays for the down payment in the first loan. So we can talk a little bit more about that.
And that's why you can cover more in closing costs also with these loans, because can you get the funding fee covered with the closing costs by the seller?
Yeah, you've got 2 ways to do funding fees. So funding fees can be paid either upfront and you just pay cash out of pocket. You can do it that way. But the vast majority, 98% of people finance that funding fee. So if you had a $400,000 loan and your upfront funding fee is, let's say, 1%, we're adding $4,000. So what's your loan amount then on a USDA? It's $4,000 or $404,000. That's your loan amount. Because we don't have a 0, we have a 0 down payment and we're adding 4,000. We're rolling it into the loan. We don't have to pay that. It says upfront, but it's not like you gotta pay it upfront. It's just, it's a fee that gets added on upfront. If that makes sense. So VA is the biggest one. It's 2.3. And if they're buying another house, let's say they sell their house with VA and they're gonna go buy another house with VA, which you can do. It's 3.6 that second time. So now we're talking on a $400,000 loan. That's what, 12, 13, 14,400 or whatever, $14,400 that we're adding onto their loan to do a VA loan. It gets pricey, okay?
Hey, Mike, just for clarification, so the Utah Housing, the 2 Utah Housing loans, their upfront fee is the same as USDA, not the same as FHA. Your example is just 1%, right? Not 1.75?
The Utah Housing fee
Is 1 or 1.75?
is 1.75.
Okay.
Because that's FHA.
Okay, also, was your example USDA then on the 1?
Yes, that was the USDA example
Okay.
that I just said there. Yeah. Okay. The second loan, there's 2 loans with Utah Housing. The second loan doesn't have mortgage insurance. It doesn't have upfront funding fee. There's no extra fees on that. Everything is done in just the first loan. So Just to chisel down a little more, I want to explain the Utah housing just for a second, because I know, Preston, you said you were new, so you probably haven't seen a Utah housing loan. Have you heard about it, how it works? Okay, so this is unique. We're doing a first loan, a first mortgage that covers 96.5%. You see here that FHA requires you to put 3.5% down. So we're doing an FHA loan that you're putting 3.5% down, but you don't have 3.5% down. So we're doing a second loan at the same time. The second loan will allow you, depending on the loan, to go as much as 6% more than the loan amount of the first loan. So with 6%, we're covering the 3.5% down payment requirement. So now we've got 100% financing on the loan, and we have a little bit left over. We've got 2.5% left over that we can also put towards closing costs. Closing costs being $5,000 to $7,000 to $8,000 on any given loan. We can cover the majority of that with the second loan. So at the end of the day, a true Utah housing loan, you're bringing $2,500 to $3,500 total in closing costs. If we can get the seller to pay that, your out of pocket is nothing. Okay, so that's how we can have kind of a zero down program with Utah housing. Utah housing is kind of the bottom of the barrel loan. We only use it if we have to, but in this market, this is what I tell people. People go, oh, maybe I should wait and save up. What do you think about that?
They can wait and save up, but they're gonna be chasing the house prices.
Yeah, so let's say I need to save
Waiting is not
3.5%.
No.
Let's say I need to save 3.5%, which is, let's call it $12,000. And I ask a client, how long is it going to take you to save $12,000? Well, I think I can, do it in a year. Obviously, they're not going to do it in a year. It's going to be 2 years, right? Or 3 years. It's going to be longer than what they think. But let's say that they can do it in a year. How much is that $400,000 house going to cost a year from now?
Well, it depends where it is, but a lot more than 3%. It's gonna be like 10.
Yeah, right.
Maybe
We're
15.
increasing at such a rate right now. Yes, we are putting you in the worst loan with the highest monthly payment. If you can just suffer through this loan for a year or two, we'll refinance you and get you out of that loan into a better loan that has a lower monthly payment, that has no mortgage insurance. Why wouldn't you do that?
Is there any seasoning on how long they have to wait before they can refinance? Can they refinance in 6 months?
As long as the equity's there. We would want to wait until there's enough equity to get us to the 80% mark. 80% loan to value means no mortgage insurance. The mortgage insurance on an FHA loan, it's pretty high. On a $400,000 house, you're about $250. So just by getting out of an FHA loan into a conventional loan, by doing a refinance down the road, we're going to save them $250 right up front from doing that one thing. If we do it before they hit the 80% mark, we're still adding that mortgage insurance back on. So it typically makes sense to wait to the 80% mark. And right now it only takes us a year and a half to do anyway. So, let's just wait kind of thing. Good question. Any other questions on that? How are we on time? Oh, good. Great. And I talk kind of fast. I get going on this. Let's talk about mortgage insurance. Mortgage insurance. You hopefully can read my scribble a little bit here. Okay, so mortgage insurance. It varies from program to program. When we have a borrower call in and they say, Mike, I want to get qualified for a loan. I've been looking at loans. I'd like to do this loan or that loan. I have borrowers that'll do that. At the end of the day, what loan do we want to give them? The best loans, the one that gets them the lowest monthly payment, that meets their needs based on the amount of down payment that they have available. We ask 10, 15 different questions of them. And oh, that's better because I'm trying there. Now everybody can see. I don't know if it's, it looks pretty clear on there actually. Your camera's better than mine. So we want to get them into the best loan that works for them. How does that happen? We ask 10, 15 questions. And then when they answer those questions, we go, okay, how much down payment do you have? Well, I don't have any. Okay, that's going to eliminate this program and this program, right? And then we go, where do you want to buy? Well, I'd like to buy in Salt Lake. Okay, that eliminates USDA. Why does that eliminate USDA?
That's gonna be
Rural.
population.
right? There are no areas in Salt Lake that we can do a USDA. Anybody know some areas where we can?
Used to be Eagle Mountain, but I don't know if that's changed.
Still,
Is
and
it?
Saratoga Springs still. Yeah, any other areas?
Out by Grantsville.
Some
Yeah.
areas in Twilla County.
We go to Tooele. Most areas out there. What about Davis? No Davis. In Utah County, we can actually go south of Spanish Fork. Once we get south of Spanish Fork, you can keep going south all the way down to St. George. Once you get to the St. George area, that's not included in the USDA, but everything in between here and there is. Park City, believe it or not, USDA territory. Summit County, there's some other areas of Summit County. So there's a little thing, USDA eligible property lookup. You can put an address in there and it'll tell you if it's eligible or not. We'll do that for you, but so that's another question though. Once I ask that, they've got no money for a down payment. They've got they want to buy in Salt Lake. We've just knocked out these three. Are you in the military? We've knocked out that. We're left with one, unless they have gift money that they can get from somebody that leaves this program. So these are the questions that we ask, and we try and get to that best program that fits them. But sometimes I've got multiple programs that will work for that one borrower. At this point, I'm doing mortgage insurance really comes in. How much do you have? Well, I can do 5% down. We run their credit and we find out that their credit is 640. Okay, we can still do a loan for somebody with a credit of 640, but the mortgage insurance on a conventional loan at 640 is very high. It's astronomical. In fact, we were just doing one with one of Debbie's clients, and we compared the mortgage insurance because of his credit score on the two loan programs, conventional versus FHA. And at the end of the day, I said, you've got to go FHA. And he's like, why? And the reason was he was at $250 a month for an FHA, and it was like $560 a month mortgage insurance for conventional.
Wow.
Because his credit score was that bad. FHA charges a 0.85%. Conventional is tiered. So based on your credit score, it gets higher and higher the lower your credit score goes. And so that's one of the factors that we're considering into this. Borrowers with low credit score. So let's quantify low. 680 to 700 range, you could go with either program. The mortgage insurance is about the same. You go above 700 and you're conventional all the way. In fact, people with like 780 credit score, the mortgage insurance it can be down as low as 0.2, where FHA is at 0.85. So it's like 4 times as expensive with FHA at that point. But then you go down to the other side, 680 and below is almost always going to be an FHA because conventional gets up to 1.2, 1.3 times the loan amount. So it gets pretty expensive that way. So let's just hit these numbers. Mortgage insurance. Let's see, what do I have here? It's 0.3. Well, the range here, let's say it's 0.2 to 1.25-ish. That's the range of the mortgage insurance. FHA is almost always 0.85. It doesn't really vary. What about VA? Anybody know what the mortgage insurance is on VA?
0.
That was a trick question, but you nailed it. What about USDA? USDA does have mortgage insurance. It's 0.35. So USDA has got a pretty decent mortgage insurance rate. Here's the negative of USDA mortgage insurance. It never goes away. You cannot get rid of it. FHA, same thing. It never goes away. There is a way to get rid of it, but it takes 11 years to get rid of it. And most people will be like, I got my credit score up. I'm going to get rid of this mortgage insurance sooner. They'll refinance it. People don't typically hold on to FHA loans that long. It's unusual. And then Utah housing is the same, 0.85. So that's mortgage insurance. Do we know what mortgage insurance is or what it does? I bet you know.
It's to protect the bank.
Yeah.
Basically, you're just paying for
Yeah.
their insurance if you default. It does nothing for the.
Yeah, so borrowers love this, right?
Oh, no.
Yeah, they hate it. They hate mortgage insurance because it doesn't help them at all. The way it works, I used to have this when I first heard of mortgage insurance, long before I was a loan officer. I used to think if I defaulted on my house, the mortgage insurance would pay the entire house. That's what it would do. It doesn't actually work that way. Mortgage insurance pays the 20%, the loss that happens in that 20%. If I don't put 20% down, I put less than 20% down, the mortgage insurance protects the lender for that 20%, that little 20% margin. That's what it's making them whole on. If they end up losing more, the mortgage insurance isn't really going to help the lender. But in most cases, the lender can sell that house, recoup most of the costs, and if there is a loss, go make a claim against the mortgage insurance for that small portion of the loss. Mortgage insurance gets cheaper the closer you get to that 80% down. Now, I'm strictly talking conventional. This gets cheaper the closer you get to the 80% down, or the 20%. When you put that 20% down, it gets cheaper, and it does it in 5% increments. So 5% is one rate, 10% is another, 15% is another, and at 20% it's gone. There's no value to putting 9% down. The mortgage insurance is the same at 9% as it is at 5%. It just goes in those exact tiers, okay? FHA, the only difference with FHA is if you do put 5% or if you do put 10% down with FHA, then you can actually get rid of that mortgage insurance after 11 years. Congratulations, you just got to pay for it for 11 years. But if you do put the 3.5%, it's for the life of it. If you actually put 5% down, this does go down a bit. It goes down to 0.8 instead of 0.85, but there's no other tiers with FHA. And then the other ones are all, this is fixed for the life. This one, Utah Housing, is exactly what FHA does.
So even on the FHA, even if you pay down the mortgage, it's still gonna last.
It never goes away. If you start with a 3.5% down payment, it's for the life.
That's crazy.
And that is why people refinance out of the FHA loans. It's going to be $240 for the rest of your life.
Crazy.
Same with USDA. So I've even seen where people will refinance out of USDA. Now the benefit, here's the benefits. Let's talk interest rates just for a second. Is that on here? Is that the next one? No, it's down lower. Let's skip down to rates. It's down lower at the bottom. And I want to talk rates for a second. I want to make sure we cover some of the gooder ones. Okay, before we hit our time. Tell me what time we go till.
No.
Oh, right till noon. Okay. So let's talk rates for a second. Is anybody seeing kind of the difference between the rates, between the programs? Do you have any lenders that send that out to you regularly? It's interesting. Conventional right now, let's just throw this number in, 3.125. That's kind of around where rates are today for a conventional loan. Now you'll see on the highway, Mortgage Mike, he's got his rates today are 2.7312. I mean, it's real weird percentage. And what we don't know is this is the perfect scenario. This is a guy with 897 credit score, right? It's the guy, you can't get that high, but it's the guy with great credit. He's also buying down the interest rate a little bit. He's paying like a discount fee. He's got plenty of money, so he's putting a large down payment. I mean, there's a perfect scenario where you can get that exact rate, but most people that call in to Mortgage Mike don't get the 2.831, whatever it is. So let's just say 3.125. Lenders are going to typically be around that. They might be a little more, they might be a little less, but right now that's where we are. FHA though is going to be closer to the 2.625. So we're looking at a whole half a point lower. So people go, well, why wouldn't you do FHA? It's 2.625. And what's the answer? The mortgage insurance. The mortgage insurance, again, it's $240. You can never get rid of it. And it kind of cancels that out. So in most cases, somebody that's paying a smaller mortgage fee, a mortgage insurance rate here, is going to have a lower monthly payment than this person that's got a 2.625, and it's because of the mortgage insurance is so steep on that loan. Okay, so that's the power of it. VA is usually pretty close. somewhere around 2.5, 2.625, it's in that rate. USDA, same thing, 2.5-ish, 2.625. And then the Utah housing, how does that work? We've got two loans. Anybody know how that works?
One's a better interest rate than the second,
Yeah.
it's usually a higher interest rate.
And it's exactly 2%. So, and this doesn't apply to our people out of Utah here. You've got probably a state program that may have a different one. For example, Idaho is, if the interest rate today in Idaho is 3% on the first, the second one is 4%. Here in Utah, if the interest rate is 3%, the second one is 5%. And actually, I lied. So this is the FHA rate, the 2.625. The first Utah housing one is right around 3 today. And then the second one is at 5%. So you've got two loans, one at 3, one at 5. You add the mortgage insurance on there, and suddenly you've got the most expensive loan with the most expensive monthly payment of all the loans, because we got that scenario. Say, okay, is that?
So the FHA portion of that is a little bit higher than a normal.
Yeah,
FHA.
it is. It is higher. It's closer. It's a little better than conventional, but it's worse than the FHA. So what did I skip? Income limits. I mentioned this a minute ago. Has anybody heard the chatter about the income limitations or know what those are at all? Income limitate, I'm saying income, I meant loan limits. Let's hit income limits and then we'll do loan limits. So the income limits, that's terrible writing and I can't bend down that far. Too tall. So income, conventional has no income limitation except for in those two programs I mentioned earlier, the Home Ready and the Home Possible. Otherwise, you can make as much money as you want. FHA, same story. There are no income limitations in FHA. VA, same story, no income limitations. When we get to USDA and Utah housing, these programs were specifically designed for people that don't make as much money. So in order to get that program, you have to not make as much money. USDA, the minimum, if you've got a 2-family household or two husband and wife, maybe 1 or 2 kids, it's about $93,000-ish. If you make over that, you can't go with the USDA. If you have as many as 5 in your household, it goes all the way up to $128,000. So there's some flexibility for more members in your household, but that's the USDA. Utah housing does the exact same thing. It's about $91,000 to $120,000, depending on how many kids are in your household. So those are the income limitation requirements on those. But let's talk loan limits. That's what I meant to say earlier, loan limits. Has anybody heard the chatter about the loan limits? Right now, if you want to go with a conventional loan, your loan amount cannot exceed $548,000 or 250. So 548,250, 548,250 in Utah County. That's the conforming loan limits in our state. What happens if you need a loan for more than that? What do we call it?
Jumbo.
That's a jumbo. What's wrong with the jumbo? What's the negatives?
Qualifications and.
Qualifications are steeper. So your debt to income ratio, it's got to be lower typically. Bigger down payment. They do have some 10% ones, but often you're paying 20% down. Interest rate is higher.
Which doesn't make any sense when most of our homes are 500,000 or more anymore. you know?
That's the problem. And
What was
that's
that
what we're
number
running
again?
in. It's 548,250. Now, that's Utah County. Salt Lake County is called a high balance area. So they have the 548,250, but if you want to go up to as much as 600,000, then there's a high balance limit. So it's got a little bit higher interest rate. You can still do a 5% down payment or a 3%, just like you could with the normal conventional without hitting that jumbo limit. So those are the rates right now. FHA, it's lower. It's 430, I forgot what it was, 439 for Utah County and 453 for Salt Lake. And you know what I'm going to do, guys? I'm going to give you one of these that has all these on it.
So there's a
You're all
pile of
taking-
them over here already.
Okay. Debbie?
I gave them a month ago, but you can add yours to that.
So the point here is that they've been, what's been happening with home values, right? We all know that they're shooting up like crazy. So what they do is they look at the 4 quarters of the year and they see what the cost of the average cost of home values are in that area. And they put that together and they say, okay, we're up, we need to adjust. Last year in January, or this year, sorry, in January of 2021, we went from 510,000 to 548. So about an increase of 38,000 on that loan limit. Right now, they've just used the first 3 quarters of this year as average, and we are at 625,000 that we're looking at for the new loan limit. Once we add in the 4th quarter, we'll probably be even higher than that. So we're going to see almost, it's as much as $100,000 bump in that conforming loan limit before you have to do a jumbo loan. So kind of nice, that addresses the problem that we're having, which is, I mean, nobody can buy a house without a jumbo right now. I bought my house 5 years ago at like 470 is what I bought it at 4 years ago. And the neighbors down the street just sold theirs on my block. Everybody built their house at the same time. They just sold 2 houses. One was at 920 and one was at 970 5 years ago. It's just, so you're jumbo to buy in my neighborhood where I actually bought with an FHA loan when I did it 5 years ago. I bought with an FHA and they were jumbo. Or it might have been, actually, I think it was conventional. So 5 years ago. Anyway, that's what we're running up against. And fortunately, we're gonna have those adjustments. Now, here's the cool thing. Those usually happen in January, but we do have one lender or one, so we're a lender. We're a mortgage company. We do our own lending. We have our own money. We do our own underwriting. We do all of that in-house, but we still sell to the secondary market. So we go and we look at the secondary market. We see what rates they're offering, what programs they have. Penny Mac right now is offering you to lock in on a $620,000 conforming loan, even though they haven't announced it yet. So they're allowing it. It's a possibility. So if you've got some clients that are kind of in that, they're like looking, hey, can I do this? There is one option currently. There are some strings attached. You can't close on the house for 60 days. So you can't do a standard 30-day close on that. But if you've got a seller that's trying to sell a house and they're having a challenge and you bring a buyer and that buyer says, hey, I can do it as long as you can wait 60 days, that's a possibility. Okay, so that's the conforming FHA, I told you that. VA doesn't have one. USDA doesn't have one. Utah Housing does, and those limits vary by county, but it's in the $450,000 range. Again, Utah Housing and FHA are using kind of the same program. So what we see here, we see a 439 limit here. We're going to see a 439 limit over here on Utah Housing. So they follow the same thing. Okay. Questions on any of that? Tons of information I'm dumping on you. Again, the whole idea, you said it, I think, is, or one of you, it's knowing what is out there, knowing what options you can go and talk to your clients and say, yeah, I think I remember there was something about this. Let me check with the lender. It's just to know that it exists. You don't have to remember the exact rules. But if you do want to remember the exact rules, it's on the back of this that we've got copies of for you.
I think it's a really great idea for people to know, because if you do have a person that can do conventional FHA, but on the real estate side, we're seeing less selling agents wanting to take FHA, especially Utah Housing.
Yeah.
So if your people can go conventional, then we want to have that talk. Yes, you might pay more, or it might affect you this way, but you may not be able to get the house you want.
So let me ask you this. How do you feel about, let's say I qualify a buyer, they've got the ability to go conventional, but at the end of the day, they choose to go FHA. And this happens where this borrower that Debbie is working with, again, the mortgage insurance was double to go with the conventional program, but he does qualify to go with the conventional. He's got the money. We could write a pre-approval letter that says conventional. And then how do you feel about changing the program writing conventional in your offer, but then you change the program to FHA because it makes more sense. We still get the loan through. Have you ever done something like that?
So I can give you my opinion, Jeff, we're always,
Yeah, I love
we're
opinions.
very different.
Yeah.
And we might have the same opinion. I hate changing something in the middle because I like the other agents to really trust me and know that I am actually coming forward with honesty and integrity.
Mhm.
And to me, if you come in conventional, but you know you're going to go FHA,
Yeah.
you're not being upfront about it.
Yeah.
Because you have those disclosures, which, you know, most of the newer agents don't even know what those
That's
FHA
true.
disclosures are. The FHA disclosures come in and say that basically the borrower can get out for any reason if it
Right.
doesn't appraise,
Right.
and they have to be able
And
to
there's things in there with earnest money as well.
Mhm.
Yeah.
It's
Protections.
the timing of when that happens that
Yeah.
can kind of mess things up, and we just like transparency,
Yeah,
right? I
it's
mean, if
good.
that's an option that's gonna come up later, lay it out there. And let them know that they can go conventional, but it's likely gonna close this. I think that's respected more than switching
Without notice.
without notice.
I
Yeah,
think
for
a
sure.
lot of agents are doing some really tricky things to win, and they know upfront they're going to do those tricky things.
Yeah.
And what I'm trying to do is I'm trying to educate agents, because I'm up against people with non-refundable earnest money all the time. And I don't suggest it unless it's a very small amount. And I'll talk to the other agent and I'll say, hey, I don't know if you know how many lawsuits are going on right now about that non-refundable earnest money, but sometimes agents think they can really back out and get that money back. And I've been able to win deals by discrediting, because it does happen all the time. People
Interesting.
do 15,000 non-refundable, then
Uh-huh.
within 24, 48 hours, they'll cancel, and they don't expect that they still have to give
You've got
that.
agents that are
seller.
canceling before the 4-day requirement to
Yeah.
deposit the earnest
Yeah.
money and think that it doesn't apply because they never. deposit.
Right, right. I didn't deposit it,
Mhm.
so no
You're
big
right.
deal, but they're
And-
still
Lack of
liable
education.
because they put it on there.
But there's 50% of the sellers that are feelers that will say, oh, I would never keep their money. So they win it.
Yeah.
And here you fought really hard and you have a really great buyer, and then they come back. But anyway, I like to be transparent, and I understand that that can be a way to do it. But what I like to do with my clients that feel they want to go that route is I'll go ahead and play that game with them. We'll put in the offers, and if we lose, they make up their mind they want to do it the other way. I'm gonna let them go through that process. Does that make
Yeah,
sense?
yeah.
And then if they want to decide to change to conventional because they want to win, you know.
Well, and you're right on. There are a lot of games. So I see agents on all sides of this
Mhm.
that are, you know, coming forward with the Utah housing. They haven't been able to get them under contract, so they start thinking outside the box, right?
Mhm.
And sometimes I actually had one client that made an offer not contingent on the sale of their house. But the agent knew, I mean, this agent's been doing business for 18 years, knew that it was contingent on the sale of their house. And guess what? The sale of their house delayed. And so we had to we got the deal done at the end of the day. But now the seller calls me, hey, they've asked for an extension. Could you give me some details on that? And I'm like, yeah, we're not gonna be ready. That's all I could tell them. I couldn't say, hey, this is actually contingent on the sale of a house. I couldn't give them those details, but that was the way that they did it. So they didn't mention that so that they could win the deal. And it causes problems.
Which then if the other agent finds out on the other side,
Yeah.
if that person ever comes forward with
Right.
an offer again, they're going to
Discredited.
remember
Yeah.
that.
This is a relationship business for sure, and honesty is always gonna trump.
I love what you guys are saying. It makes so much sense.
100% of the time.
Yeah. In fact, we're moving more into this electronic age. And at the same time, we're having conversations around our office. This is still relationship. I mean, we can't do everything on Facebook. We need
Right.
the face-to-face. We need the connection. We need the contact. That's what gets deals done. That's what makes things happen.
So
Well,
for one more thing, for some of you newer agents, with what Mike was talking about before on, you gotta know enough of this stuff to have a conversation and know that your clients have options. Being able to explain it like Mike does is not a requirement.
Yeah.
But knowing that, hey, we have a couple of different things we could pursue, because everybody's file is different, right? Everybody has a different credit score, they have different debt to income ratios. So you have to sell your team. You're not the appraiser, you're not the lender, you're not title, you have a team of people around you. So some new agents that I've run into, they don't like admitting they don't know something.
Mhm.
And that'll come back to bite you. You have to know enough to then team up and guide them to the person that really can explain it properly.
That's where we build relationships with other people. I don't know what the appraisers know. People ask me, hey, why did the house appraise this way? I'm like, I'm not an appraiser. Let me go find out.
And they'll tell you don't know what they
Yeah.
know.
That's right. That's right.
They won't let you forget.
Let me point one thing out, because we're talking about this FHA. VA kind of has a stigma, a little bit of a stigma. So does USDA, so does Utah Housing. Conventional's like the golden goose, right? We've got 20% down going conventional. That's like a very strong loan. Most of these other ones we have challenges with. FHA the houses tend to appraise a little lower. VA, houses tend to appraise a little lower. USDA doesn't have that problem, but there's zero money down. How solid is our borrower that doesn't have zero money down? There's all these stigmas associated with these. So where we have had success, and I want to share this because this may be helpful, we are moving out of this negative stigma market a little bit. You guys are probably seeing more of these loans coming through than in the last year where we haven't been. But where I'm seeing my borrowers have success with these loans is that let's say they walk into a house and they're like, oh man, this house is great. This is awesome. I love this. Guess what? 10 other people walked into the house that day and had the same reaction, and you're in a bidding war. That's probably not the house for you if you've got an FHA or a VA loan or USDA. So what is the house for you? You walk into the house, you're like, this is okay. Maybe I could do a few things here. I don't love the kitchen. It's not that updated. Some TLC. That is the house for you. Because you had 10 other people that walked into that house that day and had that same reaction. They're like, I'm gonna go bid on that other house that I saw. And now you're in a competitive market of maybe one other bid or two other bids. Much more easy to get an FHA or Utah Housing loan through in that scenario. And I explain to my borrowers, I say, this is a stepping stone house. You're gonna live here for a couple of years. You're gonna take the equity out of your house, and then you're gonna go with a conventional loan and go buy that house that you love when you walk in. So I've had 2 or 3 VA loans do that and 2 USDA loans in the past 2 months that did that exact same thing. They came to me and said, Mike, I'm trying, I'm not getting anywhere. Go bid on the fixer-upper. It still has to pass the appraisal, but it's not updated. Maybe it's got some dirty carpet, whatever, walls are scratched. It's not move-in ready.
Guys, pay attention to what he just said. I mean, that has not as much to do with the loan as it does communicating with your client on proper expectations. Because how many of our clients, their expectations are a little off the mark these days on what they think they're gonna get versus what reality is. So having that conversation when you're touring properties or even before you tour properties, makes it a lot easier to bring it up when you're at that house and they're describing their wants and their likes and their this, and then that competitive nature, if that's maybe eliminated, they might have a better shot at the house. So that was a really good point.
Love to have all this information ahead of time, so they know what to expect. That way, once it all falls into place, they're like, oh, you are the expert, right? You know what you're talking about.
Yeah. So we have 1 minute left. We got 1 minute for any final questions, and then we're done. There's a few other things on here that I didn't go through. Look down there if you have questions about it. I'm happy to explain it to you one-on-one over the phone or whatever.
I have these on PDF too, guys, and I'll get them to you.
Yeah. So, and I'll leave it. I know Debbie had some back there. I've got these here, whatever.
Unmute yourself on Zoom if you have a question.
I have a quick question in regards to FHA. I guess probably VA is similar with the inspection. Is there anywhere where you can go online and see, because I remember when we were in Oklahoma City purchasing our first home, and there would be a little something, and our realtor said, if you want to use the FHA loan, that has to be fixed prior to moving in. This has to be fixed. This has to be fixed.
The list actually is surprisingly similar from conventional to FHA.
Okay.
There are a few things. FHA, they want, I don't have a list. FHA wants working smoke detectors. Conventional doesn't care. FHA would like no peeling paint on the house. Conventional doesn't care.
Okay.
If you have a caving in roof, FHA and conventional, they're gonna say no. They're both gonna say no. All of the programs would say no to that. But FHA just wants it, if you've got wires hanging out inside your house, if you have walls that got holes knocked in them, FHA wants a finished product with working plumbing, working electrical. That's the general guideline. If you have stuff that's not working, that really should be working in order for the house to be habitable, that's FHA's requirement, plus the peeling paint. Okay? Outside of that, conventional will approve a lot of that stuff. If you don't have a working sink, that might be okay. But if you have a destroyed bathroom that you've ripped out, all the loan programs are gonna wanna see that bathroom put back together. You need a working bathroom.
Am I remembering this correctly too, Rebecca? Like if the property's vacant, but it doesn't have a stove or a range in it, for FHA, it has to have one, doesn't it?
Yeah, exactly. It's gotta be
Somebody's
habitable.
gotta provide that.
You can't live in a house without a stove.
Except for fridge doesn't have to be.
Yeah, the fridge may be acceptable. And honestly, I haven't run into those the fridge ones,
On
so.
vacant properties, I've never heard of the fridge too, but I have the stove. So
Yeah.
being in working condition, you'd assume, well, there's just one here, right? So it doesn't count, but they gotta be able to move in and be able to live there.
Yeah. So as long as you include that in the deal, you can solve a lot of that.
Yeah.
So that's why you'll see a lot of these VA or FHA addendums will say, hey, we'll do some fix-ups for up to $500 or $1,000, because they know kind of going into it that there's probably gonna be a little thing or, a couple of things that need to be adjusted. Great, I think we're out of time. Those of you that are online, you're gonna miss the food, but everybody else, we've got some food here, so thanks. Any questions, let me know.
Thanks, Mike.
Thanks, Mike, that was awesome. There's some contact information for you too, guys. Screenshot that. Lynn, you're up.
Oh, and Mark had something real quick.
Yeah, Lynn's gonna come up and
Okay, go ahead.
Yeah, I was gonna introduce you guys. Yeah. come
walk
on up.
around.
Gotta get right in front of that camera.
All right, am I good?
Swing out there.
Hey, we got a couple things here that we wanted to point out. First we want to congratulate Sydney on her second baby, so we brought her a little gift.
Aw.
Baby. And then you guys should be all aware that Lynn's birthday is 23rd
Yes.
of October, so happy birthday, Lynn, and
Hey, mine's in July.
without Jeff, none of this would be possible, so he can decide what flavors they want on the cakes. Thanks so much. Yeah, and you guys are awesome. Thanks a lot.
Well, and I wanted
For having
to introduce their team because you can see that they're supporting us and this class was amazing. I wish I would have had this my first year in real estate. Because even though we don't have to explain these things to our clients, it's really good to know it. It shows that you're the expert. It shows that you're caring about your clients and making sure that they are, getting the best products. Debbie also did a class, so they're all with the same mortgage company.
Yeah, we're all on the
We're on
same
the
team.
same
in fact.
Yeah, they're all on the same team, so reach out to them. They're here to support us. And Mark is a connector if you need anyone for anything. The first time we talked on the phone, we were on the phone for like an hour and all he was about how can I help you? And Debbie's been the same way, Mike's been the same way. So anyway, I just wanted to say thank you and introduce you to everybody.
Thanks, guys.
Thanks again, and then we have Walk the Line, and that's actually a buddy's restaurant that I know. He's down in PG, and he owns Walk the Line and this place called Under Wraps, and it's Walk, WOK. Walk